Many Americans are struggling with finances a year into the pandemic here, but a new CNBC survey shows the hardships are not being felt equally across race and gender lines. Our Sharon Epperson has the details. Hey, Sharon.
Hey, John, looking at saving and investing nearly 1 year after the COVID-19 crisis began, the latest CNBC and Acorns Invest in You survey conducted by SurveyMonkey found stark disparities among some groups. In terms of saving for the unexpected, 52% of respondents said they'd tap their savings account if they needed $2,000 for an emergency. 10% said they'd borrow the money from family or a friend. But another 10% said they didn't know where they'd get the money. Blacks were more likely than Hispanics, whites, or Asians to say that they did not know how they'd come up with that much money for an emergency. And compared to the overall average, the share of Hispanic and Black women who couldn't come up with $2,000 nearly doubled at 19% for each group. Now, those numbers are bleak, but so were findings before the pandemic. In 2019, the Federal Reserve found that 12% of adults were unable to pay even a $400 emergency expense. Now, when it comes to investing, there were some encouraging findings for new investors. 10% of respondents said they bought stock for the first time in the past 12 months, and 7% started contributing to a retirement account during the pandemic. A greater percentage of new investors were people of color. While 8% of whites bought stock for the first time in the past year, 13% of Hispanics, 13% of blacks, and 14% of Asians were first-time buyers. And on these survey results came from a diverse national sample of more than 6,000 adults with family incomes ranging from $15,000 to over $150,000 last year.
It's great data and insight, Sharon. Thanks. Now let's continue the conversation. Bring in Northern Trust Asset Management President Shundron Thomas. Shundron, great to have you back. And I want to cast this conversation in the context of what we're seeing happening with retail investors in the markets overall. This idea that more people are trading than have been before, sharing ideas, sharing information. What's the upside of that? And do you see any downside?
Well, when you think about the dissemination of information, I think that's very important. What's also important is the dissemination of good advice. I mean, you've kind of referred to that in some of the prior segments. And so while I think there is an upshot to people being more aware of their avenues for investment, we have to realize when we look across racial lines that there's still vast disparities. And so, for instance, if you look at whites versus blacks, much of the wealth over the last 2 decades for whites has actually been gained through the appreciation of financial assets. So while we're citing surveys that you have some first-time investors there, still when we look at broader Federal Reserve data, vast majorities of blacks and Hispanics still don't really invest in financial assets. So they're not really having the benefit that we're seeing when we see financial assets rising. That's the big question mark for me. It's encouraging to see people starting to get into the market, if they're in to stay, if they're in with a game plan, if they're in with discipline. I worry because we've seen cycles where the market's hot, people who aren't really familiar with it jump in because it's trendy, and then they get out after the markets tank when really they should be buying more. Are you concerned that that could be what we're seeing here, and what do investors need to know or keep in mind during a time like this? Well, here's one of the things that I think about. It's easy for us to focus on what's right in front of us in terms of availability, the concern of people getting in and out, and we should always be concerned about timing. But over the long term, it's secular trends. So, John, what I would say is, first of all, actually what you're seeing among minority investors is they actually, on average over time, have less equity exposure. And so there is a bias, for example, to have, quote unquote, more safer assets, think like money market funds, savings bonds, and the like, versus, say, public equities or even private equities. And so, interestingly enough, what you find over time is they not only get less of an absolute return on their investments, but they actually get a worse risk-adjusted return. And this is a very important point. This is actually true when we look at wealthy blacks and Hispanics when they invest. And so it follows you up the wealth spectrum.
Shundron, good morning. It's Deirdre. I wonder what you made of Charlie Munger's comments yesterday, saying basically that newer retail investors need to sort of be protected, or they're being taken advantage of in the current environment by apps like Robinhood. Robinhood responded saying that they should be celebrated because we're seeing investors begin to diversify. So is this sort of part of the process of having new investors come into the market, experiment, make mistakes, and eventually get to that more educated or long-term investment pattern?
Yes, I think that I would come at it from a slightly different way. I think we should be concerned with some of the speculation that we see in the market. But there are two things that I would focus on. First of all, we have to think about market structure and the governance over that. And so while we're concerned certainly about retail investors, we should look at investors across the spectrum. What we allow, whether it be through the access of information with exchanges, whether it's institutional investors, all the way through to retail investors. So thinking about it in a comprehensive way is the best way to help all investors. And then the second part of what I think about is, again, we're talking a lot of times about access to investment opportunities, and we're talking very little about advice. And so what we need to do is really focus on how do we provide investors that now have the discretionary income to allocate to financial assets the advice that they need to actually do that well and to be disciplined, as John referred to in his earlier question, to stay in the markets over time.
Yeah, that's a difficult thing to build. Although historically, Chandran, I mean, post-war or even during war, government bonds were marketed as not just a way to help yourself, but to help the country at large. I just wonder what role you think the federal government will have to try to indoctrinate that sense of long-term investing over time.
Well, I think there are a number of things that the government can do. I know we're in a period where there are those who have lost confidence in government, but government does certain things well in terms of public policy. So first of all, as we think about not only that educational piece, but think about ways to provide more tax-advantaged ways for people to invest in retirement accounts. The other thing I think that government can do is there needs to be more diversity, in the investment advice industry. And so the government has a significant pocketbook, so to speak. So making sure that people of diverse backgrounds, women, ethnic minorities, blacks and Hispanics, are actually participating not only in the investment, but this is very important, that they're actually part of the cycle of giving the advice, that advice is permeating those communities. The government has, if it chooses, a significant positive role to play in that regard.
Yeah, interesting, because when someone understands your background, perhaps you're more likely to have their advice land for you. Chandran Thomas, thank you.
Thank you, John.